Welcome to Subramani. Unfortunately, a new COVID variant, what is called the B.1.1.529 Omicron, has been found in South Africa, and small numbers, not very intense, but yes, that meant that the markets were on a huge sell-off. Europe, US, India, everybody followed suit, and the markets were down. There was a lot of selling and there was not enough active buying. Maybe bears have smelt blood, and for whatever reasons, market was down over the last few days. And the Indian Sensex, let's say we've seen that 62,000 is now down to 57,000, which is an approximate 10%. Can we see another 10% fall? I don't see why not, simply because the markets were anyway heated up, right? So we needed some excuse for the market to come down, and this must be a great excuse for the market to come down. Whether it will stay there, whether it will go down even further, we don't know. But assume for a minute it goes down another 10%, which means you're talking of Sensex 52,000. Sensex 52,000 is not a very low index. Please remember that. Market has been running up maybe ahead of its time, like some fund managers are saying, and definitely it has been an overvalued market. So when the market falls another 10%, which means a 52,000 kind of a market, it would not be a bad time to be buying, because one thesis which we saw last year when we were 2000 March 2000, we were completely unprepared for that virus attack, and paid a heavy price. The market came down. 32% kind of a fall, or 25% kind of a fall in GDP was predicted, and all those things happened. The growth didn't happen. All over the world there was panic. Now we are slightly better equipped to handle with this crisis. We may have another crisis like the Wuhan virus, but that's a completely different story. I'm talking of this virus. There is enough understanding. There will be quick measures taken by governments, companies, etc. So my thesis in this market is buy on dips. So if the market does go down to 52,000, and I'm not saying it will go down in a hurry, it may not go down in a day, it may go down over a 15-day, 20-day, 1 month kind of a period, very slow grind down to 52,000. I would be a buyer at 52,000. Even at this 57,000, I was a buyer yesterday. I bought some automobile shares, etc. Luckily, I had sold them some time ago, so buying them became very easy. I don't want to name the shares, but yeah, automobile parts, and something which I had sold and I was sitting on, so those were easy pickings for me. So what else would you, I mean, my overall COVID related action in the market is buy on dips. Having said that, I also said is that market is definitely hot and very, very overvalued. Interest rates can go up. The Fed will taper. We do not know when it will start. So those are the negatives, and they stay. I'm not saying that therefore there is going to be another bull run, but I'm saying that if you are sitting on money, if you have sold shares and you wish to invest, this is not a bad time to look at the markets another 10% lower. So a 20% dip in the market is not too bad for buying. It is not to panic and sell, but of course if you need money in the next 2-3 years, it's not that kind of money that I'm talking about. You have to have a 10-year time frame, at least 5. Anything less than that does not make sense. So if you have a mutual fund where you're putting money, maybe you can put more money. But if you are a direct equity guy, maybe you can buy some of the shares. So what would you, I would look at buying some shares which are opportunity shares, where the fund manager knows what to sell and what to buy. But even in a generalized fund, which is a large and mid cap, flexi cap, or a multi-cap fund, I wouldn't hesitate putting money. I might actually in my SIPs, I may put a little more money. I mean, if I'm doing a 25,000 rupee SIP, I may suddenly put another 5 lakhs into it. I'll do many of those things. But having said that, please also understand that in March 2020 the market may not have been so high, and therefore the market took only a 20% fall. What happens if all these factors combine with the fact that fund managers have to book profits also, right? November, December is the time when they book profits. Their own salaries and bonuses have to be paid, so they need liquidity there. Some redemption pressure could be there. So all that put together, if it has been causing the redemption, then the recovery might take a little longer, but recover it will. So if you take a 6-month view or a 1-year view on the market, I would be very, very hesitant putting money. So therefore this 10-year view, or at least a 5-year view. So which are the shares which will take a hit and which are the shares which will do well? This is exactly the place where the human thinking comes. So everybody knew that let's say Indigo fell from about whatever price to 900, maybe it was 1800, I remember, March 2020 perhaps, or February 18,000. From 18,000 it fell to 9,000, and at 9,000 it turned out to be a great buy. That we are talking of a 50% fall. What happens if the market falls 50%? Very unlikely. I don't think market falls 50% for a variant of a virus. When there is a virus, the market fell 20% or maybe 22%. But for a variant, will it fall 50%? I am extremely skeptical, so I don't think that worries me. 20% fall, yes, perfectly possible. Would I sell my shirt, pant and house to invest? No, because the other factors which say market is overvalued still stays. Interest rates are still low, but when the interest rates go up, there could be some more reversing of the arbitrage trade. So all those things are still in place, right? Nothing changes. Only maybe we are saying this Wuhan this variant, South Africa variant of the Wuhan virus may be not so intense, and the solution could be easier, right? So if there is a correction, I would be a buyer. And what would I be buying? I would be buying those shares where I see maximum correction. Now the market may fall 10%, but maybe the Indigo, Thomas Cook, Mahindra Holiday results may fall 20%. And this or anybody connected to travel, any luxury, and India does not have luxury liners. So you will have to go by these hotels, maybe conference rooms, and those are the ones which are in threat. The another worry is the hotel. I mean, I'm scheduled to do tons of training at the physical level. Right now I have no clue how that is going to happen and whether that is going to happen at all, right? So we don't know those things, so some of those things will be affected. So typically, who are going to be the beneficiaries? Definitely home media, right? So your Netflix, your Sony Live, and your Disney and Hulu, and all those people will definitely be beneficiaries. Food delivery at home, Zomato and Swiggy will definitely be beneficiaries. More people will buy food from home. Eating out will go down. Eating out reminds me, so specialty restaurants will take a hit because the markets are not likely to, people are not likely to go back to the restaurants. They were just about starting, and there are more lockdowns, etc. Even if the lockdown is in US and UK, there are people who believe that those governments know better. So when there is a lockdown there, they're very likely that the restaurant turnouts will go down. So restaurant is not going to be a great place to be keeping your money in. Home fitness might go up, but I don't know what products to buy in India. There are no products available. A lot of home furnishing, etc. will happen. People will redesign some more, so those things will happen. And if you're going to spend more time at home, you might buy better quality furniture, etc. Again, nothing much in the listed space in India. All your online things like your Zoom, your Facebook, your Twitter and Snapchat, Instagram, those are the ones which are going to benefit, because when people have nothing else to do, they're likely to spend more time on social media. The big tech will anyway benefit. Your Apple, Google kind of companies will definitely benefit. And then of course the pharma as a group, the pharma will definitely benefit. So whether Pfizer will benefit, or whether some Indian companies will benefit, I really don't know. But yes, these are the guys who will be benefiting. So who are the guys who will be losing? Of course, banking, financial services could be in some kind of people not borrowing enough money, not enough activity. People may invest less. So all those things could happen. Metals might get a good excuse to come down. So the metal rally could be maybe arrested a little.